Most business owners are losing money right now because of their bookkeeping. Not because the books are wrong, because the books aren't doing what they're supposed to do, and nobody told them there was a difference. What I see happen over and over again is this: the business is running, revenue is coming in, the team is working hard, and underneath all of it, there are problems building quietly, problems that don't announce themselves, problems that show up later as a bad hire decision, a vendor relationship that quietly soured, a key employee who left without explanation, or a tax bill that was significantly larger than it had to be. And when I trace those problems back, almost every single time, they trace back to the same place. The books were recording what happened, but they weren't being used to drive what happens next. I've watched this play out in businesses of every size, from companies just finding their footing to companies doing several $1 million a year with teams of 20, 30, 35 people. The version of the problem looks different at different scales, but the root cause is almost always the same, and so is the fix. I'm John Harman with Harman CPAs and Associates. We work with business owners to reduce their tax burden, build real financial clarity, and help them make decisions that actually move the business forward. What I want to do in this video is walk you through the 4 bookkeeping problems I see most consistently and exactly what changes when they're fixed, because they are fixable, every one of them. And the sooner they get addressed, the less they cost you. Let's get into it. Let me start with the most fundamental issue, the one that makes every other problem on this list worse. Most businesses are making financial decisions every day without a real financial picture, not because leadership isn't paying attention, because the picture they think they have isn't actually the picture they need. Here's what I mean. The books in most businesses are doing exactly what they were set up to do. They're recording what happened, last month's revenue, last week's expenses, what came in, what went out. That's all backward-looking information. It tells you where you were. The decisions being made right now need a forward-looking picture. What's committed over the next 30 days? What's sitting in receivables that hasn't cleared yet? What's actually available, not just what happens to be in the account? Most owners don't have those answers readily available, so they work from the best information in front of them, usually the bank balance or last month's report. But a bank balance isn't a financial picture. It's a snapshot of one number at one moment in a business that's moving in multiple directions at once. It doesn't know a large payment is going out Thursday. It doesn't know an invoice hasn't been collected yet. It doesn't separate what's available from what's already spoken for. So decisions get made on incomplete data, and that's not a future risk. That's happening right now, every week, in real dollars. Here's what fixing the macro picture actually looks like. Foundation is a weekly financial snapshot, not a full report, not a complicated dashboard. Clear view every week of 4 things: what came in, what went out, what's committed over the next 30 days, and what's genuinely available after those obligations are accounted for. A picture only exists when the books are reconciled consistently, not monthly, not quarterly, but weekly. So the numbers are current when decisions need them. Beyond the weekly snapshot, revenue needs to be broken out by source and expenses categorized by function. So when a number moves, leadership knows immediately which part of the business moved it. Receivables need to be tracked against expected collection dates, so a cash shortfall is visible 2 or 3 weeks before it arrives, not the morning it's already a problem. But here's where it gets more important, and where most businesses, regardless of size, are leaving real money on the table. Having a clear picture at the business level is the foundation, but the decisions that actually drive profitability happen at the level below that. Which service line is making money? Which client type is worth taking more of? Which project category looks profitable on paper, but quietly erodes margin when the real costs are accounted for? Most bookkeeping systems blend all of that together into a single set of numbers. And when that's the case, the reports tell you what happened at the top, but not where the money actually went. There's a reason Alphabet restructured Google the way it did. When Google was growing beyond search into hardware, healthcare, autonomous vehicles, fiber, investors and leadership couldn't tell which bets were working and which were burning cash beneath a profitable core business. Reorganization into Alphabet wasn't just a corporate structure change, it was a visibility decision. By separating search revenue from everything else, leadership could finally see the true performance of each business on its own terms, what was carrying the company, what needed more time, and what wasn't worth the investment. The principle is exactly the same whether the business is worth $2 trillion or 10 million. If the books blend everything together, the picture is incomplete. And an incomplete picture is how profitable businesses end up subsidizing unprofitable work without ever realizing it. Here's what fixing this looks like at any scale. The books need to be structured to capture profitability at the level where decisions get made by project, by service line, by client type, or by division. It means revenue tracked by category and the direct costs associated with each category tracked with it. Labor allocated to specific work, materials, or subcontractors tied to specific jobs. When that structure is in place, the picture becomes clear. Most businesses that build this view for the first time find one of two things: a service line or client type that is significantly more profitable than everything else, and they realize they've been underinvesting in it. Or they find work that is barely breaking even, or worse, that the team has been delivering for months or years without understanding the margin was never really there. Both discoveries are valuable. The first gives direction, the second gives a decision, and neither one surfaces from blended numbers alone. This one surprises people when I first bring it up. Once you see it, you can't unsee it. The way a business manages its finances sends a message to the people who work there. It's never announced. It doesn't show up in a memo. It comes through in small, repeated moments. And the team is reading those moments whether leadership realizes it or not. When cash flow isn't organized and the books aren't current, small things start to slip. Payroll hits a day late. An expense reimbursement sits for 3 weeks when it should take 3 days. Raise that was promised in the spring gets pushed to fall and then pushed again. Each one of those things in isolation might feel minor when you're managing everything else. But to the person on the receiving end, each one is a data point, and the data points add up. High performers pay close attention to these signals, not because they're looking for a reason to leave, because they have options, and they're constantly evaluating whether where they are is where they should be. When financial instability starts showing up in small but consistent ways, they don't raise it. They don't schedule a conversation. They start looking. And when something better presents itself, they take it. The person who's about to leave isn't going to tell you first. By the time you know something is wrong, the decision is often already made, and you'll almost never connect the departure to the books because that link is invisible until you know to look for it. Here's what fixing this looks like. Payroll should be a committed, scheduled obligation in the books, the same way rent is, tracked as a forward-looking line item, not just a historical expense. When the cash outflow plan accounts for payroll 2 to 4 weeks in advance, it stops being something that gets scrambled together the day before it runs. Expense reimbursements should move through a regular weekly process with a predictable turnaround the team can count on. And compensation conversations should be driven by real margin data, what labor cost actually is as a percentage of revenue, what profitability looks like month over month. So when a commitment is made, it's made from a position of clarity, not hope. Financial stability isn't just a business outcome, it's a leadership quality. And for a team at any size, that quality shows up in the small repeated moments that the books either support or undermine. Now let's take that same idea, financial consistency, as a form of trust and apply it to the relationships outside the business. Because the same dynamic that plays out with employees plays out with vendors, and the cost of getting it wrong is just as real. Your vendors have been keeping track of how you pay them, not casually, carefully. And that record is already affecting how they treat your account. You just haven't seen it from their side. When accounts payable isn't organized, when bills get paid, whenever there's a moment to deal with them. The pattern your vendors see looks inconsistent, sometimes early, sometimes 45 days late, no real rhythm. They don't call to tell you this. They adjust quietly, early pay discount disappears, Net 30 becomes net 15. A vendor you've worked with for years starts requiring a deposit before the work begins. Terms that were extended to you as a trusted account get quietly tightened back to standard. And from your side, all of that looks like just the way things are with that vendor. You never connect it to your own payment behavior because you've never looked at your payment history from their side. You don't have that record, but every vendor you work with does. The vendor who trusts how you pay will stay late to hit your deadline. They'll absorb a small change in scope without making it an issue. When something goes sideways, and it always does eventually, they'll work with you instead of enforcing the contract. That flexibility isn't guaranteed. It's earned over time through consistent behavior. Here's how you build it. Every bill that comes into the business needs three things assigned to it immediately: a due date, a category, and a place in the weekly cash outflow plan. When that process is consistent, every vendor receives payment on a predictable schedule. Take early pay discounts whenever the cash position supports it. Most vendors offer 2 to 3% for payment within 10 days, and taking it signals you are a priority account. And when something unexpected delays a payment, a brief heads up before the due date does more for the relationship than prompt payment would have. Vendors remember how clients handle the hard moments. That's the trust that actually lasts. Whether it's the team inside the business or the vendors, it depends on outside it. Financial consistency is the common thread. The books are what make that consistency possible. And every relationship that suffers because the books aren't organized is the cost the business is paying that it doesn't have to. I want to talk about something that I think a lot of business owners and leadership teams are sitting with right now, even if they haven't said it out loud. There's a decision that's been on the table: hire, expansion into a new market, significant equipment investment, new service line that the business has the capability to offer but hasn't committed to. The need is real. The opportunity is there, but every time the decision gets close, something pulls it back, and another 60 days goes by. That hesitation usually gets called caution. And I want to be direct. In most of the cases I see, it isn't caution. It's a data problem. Caution means you've looked at the numbers and you're choosing to wait. Certainty means you don't have the numbers. So waiting feels safer than moving. Most businesses sitting on a major growth decision are in the second category, not because the leadership isn't capable of making the call, but because the financial picture that would make the decision clear simply isn't there. And here's what I really want you to understand about the cost of that uncertainty. Waiting isn't free. Every month a needed hire doesn't happen, the business absorbs that gap in another form. Work that doesn't get done at the level it should. Leaders spending time in execution when the business needs them elsewhere. Opportunities that go to a competitor who had the capacity to take them. Every month, an expansion gets delayed because leadership can't see clearly whether the business can support it. The window either closes or gets more expensive to enter. None of that shows up on a line item, but it accumulates. And the longer it goes, the more it costs, even though no check was written. So let me walk through exactly what's needed to make growth decisions clearly. There are three numbers that apply to almost any significant decision, and all three come directly from the books. The first is current labor costs as a percentage of revenue. This is the baseline before adding any headcount or taking on any work that requires it. For most service businesses, labor between 40 and 60% of revenue is a reasonable operating range. But what matters more than the benchmark is the trend. Is that percentage growing or shrinking? The trend tells you whether the business is absorbing its current commitments efficiently or whether it's already stretched before the next decision's made. Second number is what margin looks like after the proposed change at current revenue volume. Not in a best case scenario, not based on projected growth from the decision, but based on what the business is actually producing right now. At current gross profit, apply the new costs and see what remains. If that number still supports operating expenses and leaves a reasonable buffer, the business can absorb the move at current volume. If it doesn't, leadership needs to know specifically what revenue threshold makes the decision viable. That's not a reason to stop. That's a target. And having a target is completely different from having a feeling. The third number is the 90-day cash position. What's expected to be available after all committed obligations are accounted for over the next 3 months. If the receivables tracking from Chapter 1 is in place, this number is knowable, and it tells you whether there's genuine runway to support the decision without straining the business in the near term. When those three numbers are clear and current, major decisions stop being feelings that leadership is waiting to get comfortable with. They become questions with answers, and answers, even when they say not yet, are more useful than uncertainty because they tell you exactly what needs to change before the decision makes sense. Now let's extend this into a related area because everything we just covered about decision-making clarity applies directly to the conversation every growing business eventually has with a lender. At some point, the business needs capital, line of credit, an SBA loan, bank relationship that needs to hold up when the business needs it most. And in that conversation, there's one thing the lender is doing before anything else. They are looking at the books, not the revenue narrative, not the growth trajectory described in the meeting, the books, because lenders have one fundamental question. Can this business reliably service the debt it's asking to take on? The only way to answer that with confidence is to look at the financial records directly. What most business owners don't realize is that lenders aren't just evaluating whether the business is profitable, they're evaluating whether it's well managed. It's organized books, even when the underlying performance is strong, signal that the financial side of the business isn't under control. That perception affects terms. It affects credit limits. In some cases, it determines whether the relationship moves forward at all. A business that could have qualified for a favorable line of credit ends up either declined or carrying a rate that reflects a risk profile the books created, not the business itself. And the time to build clean records is not the month before capital is needed. Lenders look at 12 to 24 months of financial history. They want to see consistency over time, not a sudden cleanup right before an application. The businesses that get the best terms are the ones whose books have been clean long enough that the pattern is established. Building that pattern starts now, and it starts with treating the books as a strategic asset they actually are. Because when the moment comes that capital is needed, the books are the argument. Make sure they're making the right one. I want to close with the connection that ties everything in this video together, and the one most people don't see until it's already cost them something. Business owners who pay the least in taxes aren't the ones who found the best loopholes. They're the ones whose books gave their CPA something real to work with before the year ended, not after. Because proactive tax planning and reactive tax filing are completely different things. And the difference between them is almost always the books. Here's what I mean. When a business comes to us with clean, current, properly categorized books, we can do real tax planning. We can look at where the business stands in September or October, see exactly what the projected tax liability is at current income levels, and make strategic decisions before the year closes. We can evaluate whether to accelerate certain deductions. We can assess whether retirement contributions should be maximized. We can look at the timing of income and expenses and make intentional choices that change what gets owed in April. That's tax strategy. And it's only possible when the financial picture is clear before the year ends. When a business comes to us with books that are incomplete, inconsistently categorized, or months behind, which is far more common than most people think, we spend the first part of every engagement cleaning up the record instead of planning against it. By the time the picture is clear, the year is already over. The decisions that could have been made in October are no longer available. The deductions that weren't captured because expenses were miscategorized are gone. The retirement contribution window may have closed, and the tax bill reflects all of it. That's not a tax problem. That's a bookkeeping problem that shows up in April. There are three specific ways that clean books directly reduce the tax burden. The first is expense categorization. Every business expense that is properly categorized as a deductible business cost reduces taxable income dollar for dollar. When expenses are miscategorized or not captured at all because the bookkeeping isn't current, those deductions are invisible at tax time. I've seen businesses leave tens of thousands of dollars in deductions on the table simply because the expenses existed but weren't recorded in a way that supported them. The money was spent. The deduction should have been there. It wasn't. Second is quarterly estimated tax accuracy. Businesses without a clear current financial picture almost always have problems with estimated taxes, either overpaying throughout the year and losing the use of that cash, or underpaying and facing penalties when the return is filed. When the books are current and the financial picture is clear, estimated payments can be calibrated to what the business is actually earning, not what it earned last year. A difference in cash flow compounds over 12 months in ways most owners never calculate. The third is the ability to do year-end tax planning before the year ends. This requires one thing most businesses don't have: a clear, real-time picture of where income and expenses stand in October or November when there's still time to act. Decisions about equipment purchases, retirement contributions, timing of receivables, prepayment of certain expenses, all of those strategies require current data. Without it, the year ends and the opportunity closes. The tax bill becomes whatever it's going to be, and the only job left is to report it accurately. Claim books don't just help the business operate better, they're the prerequisite for real tax strategy. And if the bookkeeping isn't current and properly structured, part of what gets paid every April is the cost of that gap. Here's what I want you to take away from everything we covered today. Every problem in this video, the incomplete financial picture, the work level profitability you can't see clearly, the team instability, the vendor relationships eroding quietly, the growth decisions that keep getting pushed, the capital conversation the business isn't ready for, and the tax dollars that didn't have to go, none of that is the result of a bad business. It's the result of a bookkeeping system that was built to record the past and left there. Information was always available, just wasn't being surfaced. And that gap, quietly, in real dollars, costs more than most owners ever calculate. The fix is the same across all of it. Books that are current every week, categorized in a way that reflects how the business actually operates, reconciled against real accounts, structured to answer the questions the business actually needs answered, not just for tax season, but for every decision being made right now and every conversation with a lender or investor down the road. When that's in place, the picture exists at every level. The decisions get better, team feels the stability, the vendors extend the trust, the growth moves get made with confidence, and the tax strategy, the real one, the one that changes what gets owed in April, finally has something to work with. If you want to know what your tax picture actually looks like when the books are right, and what that means for what the business owes this year and beyond, that's exactly the conversation I'd like to have with you. Not a generic review, real look at where things stand, what the books are currently telling us, and what's possible from a tax planning standpoint when the foundation is solid. You can book that conversation directly through the link in the description, or call us at 469-742-0283. The first conversation is just that, a conversation, no commitment, just an honest look at what's there and what's possible from here. If this video gave you something useful, share it with another business owner who needs to hear it, and subscribe. We put out practical, honest financial guidance every week for business owners and executives who want to stay ahead of the decisions, not behind them. Thanks for watching. I'll see you in the next one.